Good afternoon, everyone. Thank you for joining the National Marine Manufacturers Association for this webinar today on dealing with volatility and what you need to know during the coronavirus crisis. We are happy to be able to bring this to you thanks to our partners at Merrill Lynch. And with that, I will turn this over to Mike Ribich, who is a Senior Financial Advisor with Merrill Lynch.
Thank you. And good afternoon, everybody. On behalf of our team, Tim Jenkins and myself, we appreciate you taking the opportunity to call in and listen to us today. We have a great guest speaker on the line with us that'll give us his insights and knowledge. Joe Terranova, a frequent CNBC contributor. For those of you that have CNBC on all day like I do, you probably see him on Fast Money or Halftime or Squawk or one of the other shows he's on CNBC. So besides that, he's also the chief market strategist for Veritas Investment Partners, which is $100+ billion investment management firm that we utilize as a partner of ours as one of the investment managers in our clients' portfolio. So we're fortunate enough to have Joe on the line with all of us today and give us his insights, many of which you've seen on TV. But before we did that, Tim and I just kind of thought we'd go through one or two slides on, what we're telling our clients. And we get a ton of data, a ton of charts, a ton of research reports, every day that we can put up here. And when we go through those reports, there's a couple that stand out. And I thought this one is very interesting, and it's staying the course. It just shows you why you want to stay the course. There's a saying we have that we use, Tim and I use, is it's time in the market, not timing the market, right? Because what people don't realize is that, when you try to time the market, right, you actually have two decisions you have to make. The first one might be somewhat easy. You say, I'm going to move out of the market and sit on the sidelines for this volatility until things come down. But the second decision you have to make is when to get back in, right? And that can be a harder decision. And it can also mean that you're missing some of the best days in the market, right? I don't have this chart on the slide just again because we can be putting up a lot of data. But if you missed the best 10 days in the market, the last decade, so the last 10 years from 2020, right? We're at, the beginning of 2020, going back to 2010. So 2010 to 2020. If you were invested fully in the S&P 500, your return was 190+%. Okay. But if you missed the best 10 days in the market, right, your return went to 95%. Right? You lost close to 100% return in the market. If you went back to the decade starting with 2000, right? That was not such a good decade at all, right? The 2000 decade, because of 2000, 2001, and 2002, and because of 2008, right? The S&P during the 2000 decade was down 24%. But if you missed the best 10 days, right, your return was actually down 62%. And so, the key being is it's time in the market, not timing the market, and to stay the course, right? Markets go down, as you can see on the chart. And there's an interesting, statistic that I think out of a year, right, there's 59 or 60 days of a full year on average that have a greater than 1% decline in the market, right? And we can go on with all kinds of stats, right? On average, there's 5% declines in a year, right, throughout markets history. And if you look at, on average, we have 10% plus decline a year. But it really comes back to staying in the market, right, staying the course, as it says, and things will rebound and come back. Our outlook from Merrill Lynch's standpoint is, it was reiterated last week. If you read any of the press, if you watch CNBC, it was put on there. Michelle Meyer and Savita have been on CNBC constantly. We have a 3,100 price objective at year end on the S&P 500. So notwithstanding the market, the run up we had today, right, it was a 19+% return between now and the end of the year. Right? I think Goldman came out and mentioned theirs was a little higher, and so we picked up another 2 or 3. It looks like 3% today, right, in the market. So I'm glad to be doing this call when the market's up 3% and not down 10. But again, we think this will come back. We do have some things ahead of us that are going to be challenging, right? GDP is definitely going to be slowing, and not a pretty number next quarter, and we think we're in a recession already. But we will get through it. As you can see on the chart here, right, we have gone through multiple times of double-digit down returns and come through it, and the market is still higher, today than it was 10 years ago. People forget this, and it's interesting doing client calls and client reviews, and you can see on here, less than 15 months ago, the market was down 20+%. Right? You think about a fourth quarter of 2018, right? It was not pretty. It was down 20-some%. I remember Christmas Eve, down 600 points on Christmas Eve. Merry Christmas to all of us in the investment industry, right? But we will get through this, right? And so, looking forward to hearing what Joe has to say. For those that are not familiar with Tim and myself and Merrill Lynch, we've had a 20-plus year relationship with National Marine in managing their retirement plan and their pension plan. And about 2.5 years ago or so, National Marine rolled out a marine industry retirement plan. It is a multiple employer retirement plan. As you can see on the screen here, it allows each company to be able to keep their own plan design and essentially run the design of the plan the way you want to run it. But you receive the benefits of asset pooling, centralized reporting, et cetera. Really the cost benefits, right? So instead of pricing the plan as an individual plan, you're getting priced among a very large pool, $100 million plus pricing. So, a little quick plug for the Marine Industry Retirement Plan, right? As I like to say, just top 5 reasons to join the retirement plan. If you haven't looked at it, if you haven't had us perform a comparison or review, we'd welcome that opportunity. But as I tell people, it saves employers time, it saves employers costs, and it reduces your fiduciary risk. And given everything that's going on and the environment we're in right now, we're actually finding a number of employers looking to cut costs and to save money. And so if you just go right to the bottom, right, if you have a plan audit on your 401k plan, that goes away, right? You no longer have to have that by joining this plan. And so right there, that's a $9,000 to $25,000 a year savings, right to your bottom line. You no longer have that audit cost on top of the potential savings from discounted investment expenses, advisor, TPA, record keeping. So again, that this is not the point of the call. We just wanted to give a 1 or 2 minute, plug on the retirement plan. We would welcome the opportunity to review your plan. There's information on National Marine's website regarding the Marine Industry Retirement Plan. More importantly, Tim and my information is on the screen here, and will continue to stay on the screen for the remainder of the presentation. Joe's going to talk. And lastly, on the bottom of what's on the screen is some additional resources that are available to everyone that's on this call. Merrill Lynch puts out a daily audio cast from our chief investment office at 2 p.m. Eastern time every day, right? And then they keep some replays up there. And then we also put out timely insights on Market Volatility website. So every day or every other day, the Market Volatility website is updated with our latest thoughts and insights. So both of those are public websites, so you can go to those. You don't need a password or a code from myself or Tim. So we encourage you to bookmark those, save those as favorites, as resources you can go back to as these markets continue to be volatile. And again, looking forward to hearing what Joe has to say. So with that, again, I'm going to turn it over to Joe Terranova, Chief Market Strategist for Virtus Investment Partners.
Well, thank you very much, Mike and Tim. I appreciate you trusting me with your clients and inviting me on the call. Certainly a very troubling circumstance to be on this call with all of you today, but let me share with you, I do view this as a tremendous opportunity when you think about the capital markets in the form of portfolios and opportunities that can arise. First and foremost, I think there's 2 conditions to understand. The capital markets have placed diversification on sale in the capital market secondarily have placed quality on sale. Mohammed Al-Arian in the last couple of days has commented, I think he's presented an excellent observation. Mohammed has said it's not about the destination, about the journey. For those of you on the call who obviously have an affection towards marine life and boating, think for a second about the destination that you may set forth on an early Sunday or Saturday morning. Think about the journey, how much you enjoy it along the way. I think this is what this is all about. It's about the journey, not the destination. The destination, I think we all believe, is one that when we look back, we'll realize was a source of opportunity. It's how we get there. So let me begin by first talking about the violence and the nature of the decline that we have experienced, okay? The correlation in the history of the capital markets to what we have experienced in terms of the violence of 23 trading days and a 32.5% decline, the only correlation that presents itself in the history of the markets is 1929. Scary, isn't it, when you think about that? When you think about 1929, you don't think about the sell-off in 1929. You think about the Great Depression, right? So the first thing we need to do is provide actual evidence that while there's a correlation between the rate of decline between 1929 and 2020, by no means does the evidence suggest that the Great Depression of 1929 will have a correlation that would lead to a Great Depression of 2020. No evidence at all. In fact, the circumstances surrounding 1929 and 2020 are completely different. See, ladies and gentlemen, the Great Depression was not caused by the sell-off in 1929. The Great Depression was caused by the inaction of monetary policymakers, the unwillingness to provide liquidity to the capital markets at a time that it was thirsty for it. The Great Depression of 1929 was exacerbated by fiscal policymakers that enacted austerity measures. They raised taxes. 2020, a completely different environment. A Federal Reserve that has been, for the better part of 12 years, and will continue to be, a friend to capital market investors. Federal Reserve that in the near term has accommodated investors with monetary policy that's historically friendly. Let's think about this for 1 second. Let's provide the evidence. Different circumstance. There was a Federal Reserve meeting scheduled for Wednesday, March 18th. Prior to that, Friday, March 13th, President Trump from the Rose Garden holds a press conference to speak about COVID-19. Market rallies 2,000 points. In fact, the S&P closes that day right where we are today. Same spot, 26, 26-ish, okay? Over the weekend, Apple announces that they're going to be closing their retail stores. For those professional investors in the capital markets, that Sunday we knew we would be facing a very challenged opening for the S&P 500. And in fact, the reality was you had on Monday morning a very challenged opening for the S&P 500. However, what the Federal Reserve did, which is so important to all of you on the call, is they went ahead, they didn't wait until Wednesday's meeting. Sunday evening, they announced exactly what markets were thirsty for. Complete opposite of 1929. They gave you a 100 basis point cut to 0 to 25 basis point for the Fed funds rate. They announced $750 billion worth of QE. In the week that followed, the Federal Reserve addressed pockets of contagion within the credit construct of the capital markets. Commercial paper had funding issues. Federal Reserve set up a commercial paper funding facility. The municipal bond market was experiencing significant dislocations. The Federal Reserve stepped in and provided liquidity to the municipal bond market. The Federal Reserve introduced the construct to support the corporate bond market. And lastly, the Federal Reserve last week announced that $750 billion in quantitative easing was not enough. They were actually going to target an infinite amount of asset purchases. Now, $75 billion per day of treasuries are currently being bought by the Federal Reserve. On April 2nd, they'll moderate the pace of those purchases to $60 billion. The size of the Federal Reserve's balance sheet right now stands over $5 trillion. You could hear that number and you could question yourself and say, in which direction are we headed? Massive deficits, rising inflation? Given the deflationary circumstances we're in, one could only wish for that. So is it warranted to give consideration to something like gold in a portfolio? Of course it is. Maybe somewhere between 3 and 7%. That makes sense. Why? Because we're not sure what the monetary outcome is going to be. Is it going to be continued deflation or is it going to be inflation? Either way, the Federal Reserve is active in monetary policy, supporting the credit markets and being friends to investors. Now, we completely dismiss, based on the evidence, a corollary economically between 1929 and 2020. What we do have is the very first biological circumstance that has created a recession. In its nature, recessions are caused by financial market imbalances. This recession is being created because it is manufactured. It's actually man-made. It's man-made in the sense that you have a biological crisis, and the only way to mitigate this biological crisis and flatten the curve, as we've all heard from our healthcare leaders, is to freeze economic activity, okay? Create what I would call a still society. So, what does that do? You freeze economic activity, you place the economy in a manufactured economic recession. What it does is it presents an incumbence on the part of healthcare leaders, political leaders, monetary policymakers, and fiscal policymakers to create what I call a mosaic of coordination to eradicate what I will identify this crisis as a crisis of preservation. Think about that. We're challenged by a crisis of preservation. It has an economic and humanitarian impact on our lives. Most economic crises are crises of confidence. This is a crisis of preservation. Now, in that crisis of preservation, what you need to do is you need to create a process. As I suggested before, it's about the journey, not the destination. The destination is we all look back on this, but we understand this was a great opportunity for portfolio construction. What does the journey look like? What's the process like? Well, we need this mosaic of coordination. Mosaic of coordination, then in its nature, doesn't use the performance of the S&P 500 as the referendum. What it first looks up is liquidity. There's two words I want you to think about. I want you to think about leverage, and I want you to think about liquidity. Very important words. As example, when I mentioned liquidity, from 2000 to 2019, there were 3 years where the S&P 500 was the leading asset class. Only 3 years. There happened to be 3 consecutive years 2013, 2014, 2015. What happened was, in December of 2012, the Federal Reserve introduced liquidity measures, increased liquidity measures in the form of QE3 that took the size of the Federal Reserve's balance sheet from $2.7 trillion to a high of $4.5 trillion in January of 2015. Embodied within that duration of balance sheet acceleration was the S&P 500 acting as the leading asset class globally. Why? Because we've created for investors a sea of liquidity in which leverage can be nourished. The same circumstance was created by the Federal Reserve in January of 2019. You think about the fall of 2018, the S&P 500 declined 20%. Why? Because at the time, the Federal Reserve made a rookie mistake, I'll call it. And thankfully, by the way, now looking back upon it, because it gave them the flexibility to enact the accommodative measures that they're doing now, what the Federal Reserve did at that time is they took away some of the liquidity. They reduced the size of the balance sheet. The capital markets didn't like it. The reintroduction of liquidity was in the form of communication in January of 2019. Chairman Jay Powell communicates to the capital markets that the balance sheet reduction will pause. There'll be no further rate hikes, and pivots to actually expanding the size of the balance sheet ultimately and lowering rates in 2019. Liquidity provided to the markets once again, nourishing the leverage. Liquidity sought safety. Liquidity sought safety beginning January 15th of 2020. Financial institutions in the United States report their earnings, historically strong earnings, but the response was negative. There was not a positive reaction to the earnings. What was going on was the visibility signs that COVID-19 was going to create a problem for the global economy and for capital market assets. The price of the U.S. 10-year went from 1.85 in the middle of January to 1.50 by the end of January. And the end of January was really the height, the peak of the Wuhan crisis. It was telegraphing, the Treasury market, what was to come. What was witnessed then in the preceding month was the Treasury market became the main market, the object for all in the professional investment community. Everyone was focused on the Treasury market. Why? Because Treasury yields were rapidly declining towards 1%. And there was an actual conversation about Treasury yields breaching into negative territory for the 10-year. In that environment, liquidity became scarce. It became scarce because there was a heightened sense of urgency to raise as many dollars as you possibly could. Sell your assets and buy as many dollars as you possibly could. What was addressed by the Federal Reserve in the last couple of weeks was they wove the fabric of this mosaic of coordination that's needed in the recovery process, this journey. They wove the mosaic by returning liquidity to the credit markets first and foremost. Don't think so much about the equity markets. Focus on the credit markets. Let me give you some constructive evidence about how significantly there's been a favorable shift in the credit markets. I'm in my office, I'm looking at my whiteboard. Up on my whiteboard, I like to identify the weekly range for a given asset class. It gives you a reasonable understanding of what I'm defining in terms of heightened sense of urgency. As we witnessed the deterioration in the 10-year Treasury yield that made the world economically uncomfortable, I bring you to the week of February 21st. At that point, there was limited volatility in the Treasury market. In fact, that week, you only had a high to low of 14 basis points for the Treasury yields. The sense of urgency, the heightened sense of urgency built. 2 weeks later, the 10-year Treasury had a 51 basis point range. 3 times as large the range expanded than 2 weeks ago. 1 week later, the week of March 13th, and March 13th being the exact Friday that President Trump spoke from the Rose Garden, we were now up to 80 basis points as the range in a fever pitch of heightened volatility. Ladies and gentlemen, 2 weeks later, because of the Federal Reserve, because of the liquidity, because they've addressed the global need for U.S. dollars, the range last week for a 10-year Treasury was 22 basis points. That is the lowest that it has been since back in February. That is a significant decline from the 80 basis point range of 2 weeks ago. So the first place we're looking for comfort in this process is in the credit markets. We find it in the compression of volatility for the 10-year Treasury. Secondarily, we find it in the fact of, on a day like today, for the very first time since March 4th, the high yield market experienced a debt offering. Yum Brands this morning announced that they were going to offer $500 million worth of senior notes, 5-year maturity, 2025, priced somewhere with about a 7.75%, 8% yield. Well, as I said on CNBC today, it was oversubscribed, and Yum came back at about 11:30 and said, okay, you want to give us $500 million? We'll take $600 million. Raise it by $100 million. Closing it out by 12:30. Went off tremendously successful. So the high yield market open for business today. First time since March 4th. Thank you, Chairman Powell of the Federal Reserve. Sea of liquidity. The sea of liquidity is re-nourishing leverage in global assets once again. In this process, we're not looking for, did the S&P 500 make the bottom? We're understanding that diversification is on sale, that quality is on sale. We're understanding that for the very first time when I talk to you about diversification, most people think about diversification by asset class. You look at a portfolio, you say, okay, I could be diversified, I could buy bonds, I could have my stocks, I could have a little gold, I could have a little real estate, okay? Now, I want you to go beyond that. For the first time in many years, okay, we could competitively think about a balance geographically, diversification. We could think about diversification by equity size class. If I go back and I identify the 8 instances in the market where the capital markets have declined by over 20% since 1980, do you know what equity size class has led the capital markets out of each one of those declines? Small caps. Small caps. Something that in the last couple of years have underperformed relative to the mega cap technology behemoths. So I could look at diversifying by equity size class, small caps, SMIDs, small mid caps. Lastly, I could diversify by strategy. I could diversify by growth, yes, by dividend, yes, by momentum, and to a certain extent, I could diversify by value, although value might be slightly challenged moving forward because of energy. And we'll talk about energy and the negative impact that energy has moving forward. But this diversification story has been placed on sale. Quality within the capital markets further has been placed in sale. Let's talk specifically about the equities market. I think a lot of us 1 week ago were talking about an S&P 500 that traded down to 2191 and broke below the December of 2018 lows. Very troublesome for many. However, when you looked internally, what you understood was that the weakness of the S&P over the last couple of years was where the price action could be found below the December 18 lows. So it was some construct of brick and mortar retail, the energy market, they all broke below the December of 18 lows. Quality, as measured by, let's call it Amazon or Apple or Microsoft or Nike's or McDonald's, they maintained above their December of 2018 low. So quality was placed on sale as well. So you've got this process of recovery, this journey that we're going to go on, and we need to be patient in it in understanding its evolution. But as we do that, we understand the opportunities that are presenting itself. Now, when I talk about those opportunities and I talk about fixing the credit markets and having the liquidity be flush, I gave you the example of the impact of liquidity in the markets early in 2019. Gave you the example of liquidity from 2013 to 2015 impacting the markets. I gave you the example of when liquidity doesn't impact the markets, like in prior circumstances, okay? So it can't all, though, just be about the Federal Reserve. We need more than the Federal Reserve. We have a still society. That's a positive. We have Federal Reserve who've used the word infinite. That's a positive. We have asset liquidity that are impacting the global markets. That's a positive. What do we still need to improve on? What are those conditions that need to get better? First and foremost, we're looking towards Italy as the analog for our can look at and have a degree of confidence that the numbers that are being reported are accurate. Thereby, we can analog the guessing game that we're all playing when the peak of this horrific virus, okay, will impact America. So Italy is incredibly important. In the construct of Italy, the daily growth rate is coming in somewhere around 6%. 3-day moving average is 7%. That's better than the double-digit numbers that we were experiencing last week. I don't think that there is any irony in the fact that capital markets, equity markets have improved in the last week, while there's been a we need further improvement in the daily growth rate from Italy. We've got to get that more towards 3 or 4%. We're watching Italy, still a negative. Secondarily, there needs to be this unified acceptance, the concept of all for one for all. There still seems to be domestically here in the United States some
It looks like we're breaking up there a little bit on there. Francesca, are you there? Joe? All right. Sorry, folks. Look at Joe. We're just having again remote work from home technical difficulties.
It appears there may be some
difficulties.
Yes.
We'll wait and see if we get him back. A couple of notes, a couple of things that Tim and I just wanted to touch on at the end that we'll just do now is things that we're doing with our clients, things you should be doing right now in your own portfolios, right? These downturns present some opportunities. One is the tax loss selling, right? So if you have taxable assets, definitely using these times to take tax loss selling and do tax loss selling, right? You can carry forward those tax losses indefinitely. So sell out of something that has a loss and go into the same thing the same day, and that way you bank that loss. Joe, did we get you back?
I don't think so, Mike.
The second thing I think we're doing is rebalancing portfolios, right? So interestingly enough, Joe talked about the 18th and the 19th of March, right? At that point, the Bank of America Merrill Lynch Bull Bear Indicator, which is an investor sentiment indicator, reached an all-time low, meaning investor sentiment was at an all-time low. I tell people out of a scale of 0 to 10, with 0 being the lowest, we were at a 0.4. And so for that was a buying signal for us, right? We came out and put a buying signal on from an investor sentiment standpoint. So going in and rebalancing your portfolios, right? Another thing was just the variance in portfolios, right? Joe talked about, and I think he did a great job talking about diversification, but if you had a moderate portfolio or balanced portfolio that was 64 or 65% stocks, that reached down to a level of 55%, right? And so seeing that we had a variance from our target allocations and looking at a couple other indicators in addition to our variable indicator, one of them being the fiscal policy and monetary policy that Joe referenced, we rebalance portfolios. So things that we're doing in the market today to help portfolios. Did we get Joe back, or Francisco? Did we get him? I think we dropped him there. Something happened, so we apologize for that. But again, I think it was good to have 20-minute commentary on kind of where they see the market things. Why, again, from our side of the view at Merrill, why we see this is different than the Great Depression a lot of times, and I think that was a good analogy to use early on. We also, hear that, hey, this is similar to 08. And Tim, you want to just touch on briefly while we're seeing if we can get Joe back on why this might be different from 08?
Well, I think that the fundamental issue is the structure. And remember, 4 weeks ago, we were the strongest economy on the planet Earth. The banks are so far head and shoulders, light years ahead of where they were in 2008 and 2009. I like to equate this, since one of my clients was talking about this is like a snowstorm. Structurally, nothing changes from when we went in and where we're going to come out. It's just this interruption in between. The roads didn't break, right? The bridges aren't broken. It's just this event that you can barely plan for that occurs, and then you got to wait it out, and we come out the other end. I think we see some interesting structural changes. Are we more in a domestic economy versus global? That's a question that's going to be answered. We're hearing rumble. How do you spend your money? Is it going to be more family oriented? Is it going to be more leisure family oriented? We think that's going to be a major change as you come back out the other side. People are learning how to be together, and we think that's going to translate into economies or spending around family, leisure, and togetherness. But structurally, we just don't see the same data points that we saw in 08 and 09. And I've been doing this since 1980, so I was 87. I've been through many of these crises. There's just not the structural deficiencies we had going into the last several.
Thanks, Tim. So we have a question that came through that I think, while we're waiting for Joe, and I just got an email that they're working on getting him called back in. Something happened and you dropped the call. The question was, with all the federal support, will the markets still be in better shape? Right? Will it be enough policy once all the bad news of COVID-19, of unemployment, oil disruption, and bad financial recession hits the fan in the post-thought economy? So it's interesting. I mentioned on it earlier, right? Just briefly. Bank of America Merrill Lynch was one of the first major firms to come out and say, hey, we're in a recession, right? Well, technically, we haven't had 2 quarters of negative GDP growth. We actually are forecasting that, Q1 is going to be, negative GDP growth, and we're actually forecasting negative 12%, GDP growth for the second quarter. So we already, came out and said that, hey, we're in a recession. I think unemployment numbers, right? You talk about record unemployment numbers. It was big last week. I think it's going to continue to get bigger, but part of it, I think, is priced in, right? One of the signs of that is that if you look at last week, right, markets opened briefly in the morning down because everybody was expecting the number to be big, and then by the end of the day, it went up. The market rally and closed positive, right? So we actually are calling for the market to rebound, kind of this V-shaped recovery, right? We think it's going to be very rapid. So we actually see, small positive GDP growth for the third quarter, and then positive GDP growth for the fourth quarter. We think that for the full year we're going to be just under, just barely negative. I think our forecast is negative 0.8% for GDP growth for the U.S. But globally, we think we're going to be slightly positive on GDP growth. I think it's a positive, 0.3% GDP growth. And so we have a price target on 3,100 and on the S&P, and we see it to be a rapid increase of this kind of V-shaped recovery. So, Joe, are you on?
Mike, let me just say one thing while we're just waiting here if we get that connection back. Don't discount what you can do and the opportunities presented to you on the credit markets. So on a personal side, we're talking about everybody's life here. Maybe you could refinance that mortgage, right? Maybe there's some debt that you'd like to retire. You have student debt that's high level and you do have a mortgage and equity. This is a great time to work and repair your personal balance sheet and take this as an opportunity. Mike, back to you.
Yep, I'm just making sure we don't have any other questions. Any other questions on kind of what Joe touched on and the economy, the markets? And so we have one. So all the fellow support, the markets will still be in better shape. We have that one. I think we got that one answered. So I don't think we have any other questions. Anyone else? Any other questions?
It appears there aren't. There is this one question. I wasn't sure if you kind of saw it, but it's so if we are stronger going into the crisis than in the past, do you think we will come out better than when this happened before, when we were weaker facing this?
Say that last part again. You broke up in the last part.
So if we are stronger going into this crisis than in the past, do you think we will come out better than when this happened before, when we were weaker facing this?
So you want to give your viewpoint, and then I can.
I think that the answer to that question is we will definitely be different, but I think stronger is absolutely in the cards. In that, again, showing the strength that, and I'll speak just domestically, showing the strength that this country's demonstrated, the Federal Reserve has been just phenomenal, and will on the back end of this make it much, much stronger.
Yeah, and I agree. I was going to just say that, say the same thing, is that I think it's going to be different, right? But I think we're definitely going to be stronger. I think, this time around is different than 08, and we're much better this time than 08, right? Stronger balance sheets is one of the themes we use is responsible growth, right? I think a lot of companies are going to be looking at that, and those that, especially in the financial crisis, put things in place to make sure that if things happen again, they're in much better shape. You're seeing that now, right? And so I think this is going to be the same thing, is that for those companies that, maybe didn't have things in place, weren't not using, that responsible growth or didn't have their balance sheet in order, are going to use this as an opportunity to say, okay, if this happens, we have some kind of a downturn in the economy, balance in the market, they're going to be better prepared for it and be able to withstand it better. So, I think it'll be different, but I think in the long run, yes, we're all going to be, better, positive. Again, we see, growth coming back. And again, one of the things we were looking at, somebody said, is that, before this, right, the economy was actually moving along in really good shape, right? We think we were coming out and going to be, sustainable growth going forward. So this kind of set that back. Once this gets out of the way, we think things will, start turning around. So,
I think, Mike, one of the things we want to point out is if you look at the response by the government, it's been very worker focused, right? It has been supporting when you're not working, making people able to pay their rent, pay for groceries, etc., but keep people on the payroll. How do we do that?
Yeah.
And I think that was a brilliant focus and execution. It's not perfect, but it's far different than ever been placed or tried and done in this country. And that's going to make huge benefit payoff on the back end of this.
Hey, Joe, are you there?
We'll chalk that one up, Mike.
All right.
Difficulties and leave it there.
Yeah, I think we got some good, good commentary out of them. If anybody has any questions or wants any follow-up, again, our information is on the screen. We appreciate everybody's time dialing in. And again, feel free to reach out, email, calls if you have additional questions. Thank you, everybody, and have a good rest of the day.